Can anyone hear me now? Good. Okay. Let me try something. All right. Let me try something. Okay. Give me a minute. Okay. I'm going to change to the other headset so it's much more clearer. Just 1 second. Test, test, test. Can anyone hear me now? Loud and clear? Good. Great. Excellent. Excellent. Firstly, very good evening to all of you. Firstly, my apologies because do you know that it's just now there's a slight technical issue. So as you know that this is the problem from hardware and software. So I'm glad that this issue has been resolved in a very short period of time. So basically that everyone can see my screen and hear me good. So if you can't see or hear my screen, just give a shout out over the chat box over there. So good evening, ladies and gentlemen. So welcome to Q2 2021 Global Markets Outlook. I'm Kelvin Wong, the market analyst for CMC. So some of you already heard my previous quarterly outlook. So this is a kind of a follow-up of what we're going to expect in this coming Q2, which is going to be very interesting. All right. So let me take a pause from the chat to the webcam here. So let me turn it off. All right. So before we start, disclaimer slides as usual, yeah. So just a quick shout out briefly, basically what I'm going to share later is not to be taken as a financial advice. It's purely for educational purpose. All right. Okay, let's get started. Okay, so basically this is me, myself. So for those who wants to follow me regarding about very quick updated market commentary and some of we call it kind of market analysis, we actually give a short tweet to my Twitter handle. You can follow me at Kelvin SC Wong. Okay, just sign up a Twitter account, then just type at Kelvin SC Wong and click a follow. And whatever I tweeted over here, if you on your notification, it will be reflected in real time. All right. So even before we talk about the markets, yeah, in Q2, most of us kind of a bit worried, saying that that the ongoing stock market globally, taking the US stock market as a proxy, right, saying that hey, the market has already gone up too fast and too far, and can it be sustainable? Okay, so what we can do over here is that let's go back in history, right? So what I could do is that we started off from this market over here, S&P 500 using the proxy, right? So I'm looking at long-term circular bullish trend. Okay, that means trend that actually lasts not 3 months, not 1 week or so, is in years, more than 5 years. So the earliest data we have on the S&P, right, is way before the Great Depression. That means they talk about the 1920s onwards. So the what I call prior to the Great Depression, I think it's a bit sketchy, so I will not highlight it. So once the Great Depression ended, then you have this 1942 onwards. So from April 1942 onwards, all the way up to 1973. Okay, so this is the what I call the earliest in history, the longest long-term this circular bullish trend. So this circular bullish trend, right, lasted for 334 months with a rally of 1,453. All right, then thereafter, from 1973 all the way down to 1974 over here, it started this bearish correction. All right, of 49%. Okay, so we're talking about in terms of circular trend correction, it should be more than 30%, not 20%. 20% doesn't count for that. So 49% or 50% from 1973 all the way to October 1974. Then thereafter, right, from October 1974, it started another long-term circular bullish trend. Lasted up to March 2000, prior to the dot-com bubble. Okay, so that's last for about 306 months, give you a total return of 2,384%. Then thereafter, it entered into a bearish trend as well. Okay, bearish circular trend with two declines of 50%. Dot-com bubble burst, October 2007, all the way down to the famous 666. If you could recall the March low of 2009, the 666. So it's 666,3209. Okay, so some of those who knows a bit of conspiracy theory or read about that, they say that it's the workings of some higher being, whatever. Okay, so that actually boils down for the discussion for another day. But all in all, right, what we could see over here is that this rally is about 2,304. So right now we are actually seeing, based on the previous these two very long-term circular bullish trend. Right now, we're now seeing the third long-term circular bullish trend for the US stock market, which is eventually implies to the global equity markets as per se. So from the March low of 2009 all the way until yesterday's high. Well, yesterday the S&P made a fresh all-time high at 4,148 level, there about 13th of April. Yeah, 13th of April. So this current ongoing circular bullish trend from the March low of 2009 is only lasted 145 months, lesser than the previous two trends, circular bullish trend, in terms of duration and in terms of percentage. Okay, so we are up about 522% from the low compared to the previous two, which up by 1,000+%. So this gives rise to a question that, hey, if we compare to the previous two trend, the two circular trend, this current circular bullish trend still got room to run in terms of duration and in terms of potentially the magnitude compared to versus the last two bullish circular trend. So now we're going to ask ourselves the next question over here. Can fundamentals support this ongoing circular bullish trend? Okay, so the next question we're going to answer ourselves. So the next question we're talking about fundamentals is we're going to look at earnings. Earnings will be one of them. So taking the US stock market earnings fundamental as a proxy. So as you all know that the US market is still one of the, in fact, it's still the important, we call it factor or the important driver that drives global equity market as well as the rest of the financial markets. Why? Because in terms of liquidity, the US stock market still receive the most inflow. Yeah, even though China is catching up, but in terms of the market share as a whole, in terms of we're talking about global fund flows, the US market still has a significant chunk of it. So definitely the US market is one of the the starting point for us to analyze global stock market. So as you all know that this US Q1 2000 earnings growth year on year, today, actually in fact it will kickstart today. Today, right before the market open, the financials, which is JP Morgan, Wells Fargo, as well as Goldman Sachs. But before talking about that, let's take a look at, very interestingly, what we are seeing now is the previous quarter, Q2 2020, yes, even though it's negative 4%, 4% year on year, but you will notice that it actually started to improve in the last 4 quarters since Q2 2020. And what's so important and interesting is that this time around, analysts are very, very rosy in terms of estimate. So this is estimate, not the actual one. So estimate Q1 2001 earnings growth year on year will be at 23.8%. It will be the highest since more than 10 years, since Q3 2018. Okay, so overall what you're saying that over here is that analysts estimates or consensus estimate are actually painting a very, very positive picture in terms of earnings growth for US corporation, which is telling us that, hey, fundamentals seems to be recovering pretty sharply due to the pandemic downfall. All right, so now the next key thing we're going to ask ourselves is within the sectors, because you know the S&P inside there's various sectors. In fact, there are 11 sectors in all. So let's look at the sectors estimate for Q1. So the one that has the highest change, we talk about Q1 estimate because Q1 is not over yet, it's now in fact starting to report, versus what happened in Q4 2020 earnings per share. So it's a quarter to quarter comparison, taking into expectation now for Q1 versus the previous quarter Q4 EPS, earnings per share. So the highest one, right, the highest chunk of it, right, goes to the energy, which actually gives us about 123.4%, followed by 13.1% in terms of increase. All right, jump, quarter to quarter jump. That means Q1 EPS estimate versus Q4 2020 realized EPS. So what we are seeing now over here is that we tends to be a bit rosy as well. Why? Because if you look at the chunk of it, right, still energy, financials, materials, all these are considered cyclical and value-oriented play. So what I mean by cyclical is oil value oriented, is more clearly skewed towards the global economy opening up, where stocks that are highly correlated to economic recovery story will actually have earnings being upgraded significantly. So that's what we see in energy and financials. Okay, so overall, later I'll touch on more about the relative strength versus the energy financials, taking into account the S&P, and also what drives that. That's one factor that actually driving that. So now we know that earnings growth is positive right now in terms of the expectation, and the previous 3 quarters has started to improve significantly. So fundamental has indeed starts to improve. All right, which by right it should actually supports further potential price increase in the S&P, which translate to the ongoing circular bullish trend for global equities remains intact. Then, as you all know, that over here is that, hey, how about inflation? Okay, you know that without inflation, growth and inflation come hand in hand. That means sooner or later, inflation will start to go up. And once inflation starts to go up, right, the next question you ask ourselves is, hey, will central bank starts to tighten interest rate? That's the next question I've got to answer. So now let's take a look at the inflation situation first. Okay, so before we talk about the inflation situation, let's look at some alternative economic data. These are taken from Bloomberg from 1st of Jan 2020 to 9th of March 2021. That's the latest that they have. So basically what they do, they call it high frequency daily activities indicators. So these are a bit different from your traditional economic indicator. Okay, so traditional economic indicator is what? Very simple. One is GDP growth. We're talking about PMI data. The next thing we talk about purchasers price index. Then you have consumer sentiment. Those are traditional economic indicator. So basically, what is this high frequency daily or activity indicators? So basically, in short, right, they are actually alternate data that tend to have a leading impact, a leading signal for economic growth. Okay, one example is this. So to determine, right, let's say for example, factories. How do I know that factories are producing goods? So alternative data will actually look at one thing, the power source that's coming out from the factory. That means, i.e., if factory were to be churning out goods, we need to have power supply like that's on 24/7. Then on the other hand, right, sometimes you know that companies are very smart, or countries are some countries are very smart. They purposely on the electricity 24/7, but however, inside the factory it's empty, it's not producing at all. So the other form of it is to track satellite images. That means looking at surrounding the factory, the manufacturing hub, will there be vehicles living through and fro? How intensive is the vehicle flow of that? So that's considered as alternative daily activities indicators. So let me share with you all in this chart over here, right? What's so important is that number one, the one that highlighted in gray is China. You realize that actually China, right, since September 2020, which is last year, in fact, growth has already started to pick up ahead of the rest of the world. Okay, and you realize that only GDP growth in China starts to improve only late last year. All right, but however, in September, the alternative data already start to pick up. And what's so interesting over here is that if you realize that at the start of this year, the daily activity indicators has very start to come down. Okay, which actually translate to that China itself has starts to, due to the what I call it, the policy, the economic planners in China has starts to actually come to fine tune their policy to actually slow down growth. And if you look at the last few weeks, they start to kind of be concerned about the amount of leverage that's in their local economy as well as the rest of the world, and they try to actually prick the bullish trend of the China stock market. So you realize that the China stock market, since the start of the, not the start, pardon me, towards the Lunar New Year break, that means the Chinese Lunar New Year, that means after the Chinese Lunar New Year break, around 17th to 18th of February, the stock market has started to come down pretty significantly, in line with the government planners rhetoric about the concern about the leverage in the Chinese financial system, as well as their concern about global stock market bubble. But prior to that, the daily economic indicator will start to come down ahead of that. Then what's so interesting is that if you realize that start around February to March, this is the up to 9 March, the daily activity indicator of China has started to pick up. And you realize that the last few weeks, China's stock market didn't actually fall much. They start to stabilize. All right, but the daily activity indicator tell them ahead. of the stock market. So what we could see that potentially the fall of China's stock market from February up to about last 2 or 3 weeks, more or less start to stabilize already. And what's interesting is that the daily activity indicator, this chart actually leads ahead of them due to the alternate data that Bloomberg compiled. And how about the rest of the world? So if you look at the rest of the world, it's also improving as well in terms of emerging market and in terms of advanced economy. All right, but I said that the advanced economy, we talk about those economies in Europe combined together with US, the pace is slightly slower. All right, so all in all, right, that means going forward, economic growth as indicated by global economic growth, as indicated by this high frequency daily activity indicator, seems to be painting a rosy picture as well, which by right should actually support further potential price movement in global equities. Okay, now inflation. Okay, this is the biggest concern right now. Is okay. So based on MIKIT data, IHS MIKIT, they're actually the one of the major compiler of PMI data. So what's PMI data? In short, PMI data is actually a survey on businesses, both from the manufacturing side and the services side. So take a look at this data first on my left hand side on my screen. This is global inflation. So global inflation right, is in gray. So you realize that global inflation has started to actually tick up on it slightly. But however, in February, right, based on the latest data I have for MIKIT, the input costs, the global PMI input costs has started to increase very significantly to a highest level since 2008. So what does it mean? This global input cost, right, is actually a survey that MIKIT actually ask the whole world on the aggregate businesses in the manufacturing side and businesses in the services side. Their cost has indeed went up by a significant amount. And also, both its input cost and selling price has increased as well. All right. So what does it mean from here? So it means that the cost of doing businesses on the manufacturing side and the services side has increased significantly since February 2021. So what it means that over here, it hasn't translated down to headline inflation. What is headline inflation? Headline inflation is you and I, consumers, purchase goods and services. That means right now, the businesses hasn't passed on their cost to us yet. But if we can ask ourselves, if these input costs keep increasing significantly, there is a high chance that sooner or later, profit margin may get squeezed. And to counter this squeeze in profit margin, prices of goods and services, you and I got to increase significantly. All right, and one of the answers I'll share with you is if you look at recently, right, that this global semiconductor supply squeeze, that means almost the whole world, the developed world right now, we have this high technology necessity, right? That means we can't live without our handphone, we can't live without our laptop, and we can't live without our tablets. So sooner or later, right, the prices of this handphone, tablets, and laptop will start to increase as well because of this global supply, global squeeze in semiconductor supply due to lots of reasons. It can be political. Reason is one of them because right now China and US is still not in good terms. Everyone they want to create their own supply chain for safety reasons. Yeah, so that's more on the political debate. So for the markets wise over here, we've got to be more concerned that hey, inflation will start to pick up in to the start of this quarter, means Q2 onwards, it may start to increase significantly because this is in February. So Q2 starts in April to June. So we may start to see what I call a pass-through in prices. And in fact, it already started already on the PPI. So you look at China PPI, the one that is in March, just ended in March, it jumped by 4.4%. So producer price index is also a gauge of business cost. And it's the steepest increase, right, since August 2008. Two jump, 1.7% year on year in February. March, it jumped furthermore. All right. How about another, because as you know that China itself produces a significant portion of our global goods. So definitely it will have an impact on our global services and product that we purchase from businesses worldwide. Then how about US, the world's largest economy right now? Their PPI, the PPI final demand, the final demand component has rose as well, year on year 4.2% in March, the steepest rise since October 2011, mind you. So that's about a 10-year high, okay, breaking above this trend line resistance previously. All right, so US cost has increased as well in terms of producer price index. That means the cost of doing business that goods are being produced in US has increased. All right, so all in all, what you could see now is that there is a high chance of a pass-through through CPI data. That means you and I, we may start to feel the pinch in this coming quarter for some of our goods and services that we purchase for businesses or services that we use, okay, from that. Okay, now this is the commodity price. So inflation and commodity prices will go hand in hand. So this is the latest database on 30th of April, yesterday. So very quickly, right, if you look at, okay, BBG is the broad-based commodity that consists of everything. So BBG is a Bloomberg commodity index that consists of energy, metals, agriculture, everything add together. Year to date, 7.5%. The biggest increase is your energy. WTI crude 23, Brent crude 23, then the rest, you talk about gasoline, all this, 19 to 20%. So the one that doesn't have a significant increase is your precious metal. Later I'll touch on the chart of gold, silver, and nickel. And one of the agriculture product is coffee. Okay, still negative 1.5%. So the rest as well jump pretty significant as well, especially corn in US, 16%. So all in all, what you could see is that, hey, commodity prices has really started to take a jump in line with inflationary pressure on the business side of things. Hasn't passed down to CPI yet. Okay, so later I'll share with you commodity is one of the play to look at for this coming quarter as well. Okay, now, so as you all know that the 10-year treasury yield and the commodity index has a high correlation. So this is a correlation coefficient that I plotted since 1965. So it has a high correlation of 0.61 level. So anything that is above 0.5, that means what it means that if the commodity price index keep increasing, your US Treasury yield will go up as well. Okay, so why US Treasury is important? US Treasury yield is actually a benchmark for cost of funding for corporation. Think about it as something like a benchmark where if a company want to borrow funds in the market, be it from the bank or through the bond market to raise fund, they will take the US Treasury yield as the benchmark. That means if the US Treasury is at 1%, whatever things that investors will actually pay that corporation for funding plus certain percentage due to their credit worthiness. Okay, think of it is like you going to the bank, you want to take a loan from the bank, so the bank will benchmark something, right? So the bank will benchmark a risk-free rate, like the US 10-year Treasury risk-free rate plus certain percentage depending on my or your credit standing. So if the risk-free rate starts to go up, that means the cost of funding goes up as well, correct? So once cost of funding go up, this will be a big problem. Why? Because the last few years, lots of corporation is highly levered. That means they took on debt to actually expand their businesses. They took on debt to actually do share buyback because interest rate is very low due to central bank policy of keeping interest rate as low as possible. This was their mandate in the last 10 years or so, since 2009. Okay, so now, so what level we should be concerned about the US Treasury yield? Okay, so this is a technical chart of US Treasury yield since 1981. So we have a long-term descending channel since October 2007. Now the resistance at 2.55%, which is correspond to this big congestion zone here before the recent plunge to the low of 0.36% in March 2020. So that was the pandemic low. So this 2.55% is pretty key. If it start to break above 2.55%, what we could see that speculators may start to unwind or take a bet on selling treasury bond that could push up the treasury yield much further, which indirectly push up the cost of funding for businesses and eventually me and you who wants to take up loans. All right, so this 2.55 is pretty key in terms of this US 10-year treasury yield. So if you realize that those who are actually in the market for the last 2 or 3 weeks, corporate companies that are growth sensitive. What am I growth sensitive? So growth sensitive company are companies that require more funding, such as technology company. So you look at certain technology company, or in fact most of them, because due to the negative feedback loop, the 10-year treasury has been increasing pretty steadily since the start of this year. And if you look at some of the company in terms of Apple to Tesla onwards, these are growth company, has started to underperform the rest of the cyclical and value play. All right, so that is the implication in terms of the treasury yield. But later I'll share with you more on the sector rotation using the treasury yield as one of the factor. Okay, so now the next key thing we ask ourselves, we know that commodity, that means inflation is very important. So we know that commodity prices go hand in hand with inflation. So what is the level, or what will happen, or what is the potential that commodity prices go up too fast, where will actually derail this ongoing long-term bullish circular trend of the S&P 500 and global equity? So what I plotted over here, this chart, let me do step by step very slowly. The green line here is the S&P chart in close price, all the way from 1950 onwards. And the one that is in blue is your Bloomberg Commodity Index. So think of it is that if this commodity index go up higher, like I shared with you, right, it means that inflation is going up as well, because they go hand in hand. So what you're seeing interesting right now is that since the start of the current circular bullish trend, which is here, March 2009, all the way up to the current level, April, it had comes on a backdrop of low commodity prices. Okay, you know that commodity is going up, it diverge. So what it means that during this period of time, because commodity prices is very low, it implies that inflation is muted. That's why global central bankers can afford to keep interest rate at a very, very low level, close to zero, for the last 10 years. But recently, it has started to break out this descending resistance that is taking the start of the swing high here in 2008, this level. Okay, previously was resistance, now it break out. And now my concern over here is this. I got to look at the rate of increase in the commodity price versus the rate of increase in the S&P. Okay, so this bottom is called the ratio chart. Why this chart is important? It helps us to understand the magnitude of move. And you realize that prior three instance, prior to the last three steep corrective move of 40% or more in December 1972 to August 74, prior to this steep decline in S&P, the ratio of the S&P and commodity index actually flashed a warning sign first, quite a bearish divergence. So what it means over here, before the S&P actually crashes, the magnitude of increase in the S&P is lesser than the magnitude of the commodity prices. That means commodity prices increases more than the S&P, that lead to this fall. That means it's telling us that, hey, earnings expectation fundamentally, because we talk about everything goes to driver, cannot beat the inflation pressure. That's give rise to this divergence over here. Prior to the dot-com bubble burst, August 2000 to September 2002, it also flashed a bearish divergence as well. Okay. Test. Yeah, can anybody can hear me? Because just now someone said my voice is cut off. Okay, good. Okay, so prior to this last the correction of August 2000 to September 2002, we have a bearish divergence as well, a pre-warning sign before this crash. Now, this is the October 2007, February 2009 crash, the great financial crisis. Prior to that, there's a bearish divergence as well. And right now, what's positive is that the prices of commodity prices is moving at a lesser magnitude compared to the S&P. That means there's no divergence yet. That means, i.e., an imminent crash seems to be pretty remote right now based on the previous behavior of this ratio. It means what it's telling us over here is that the potential earnings expectation going forward on the S&P is expected to rise much faster than the expectation of inflationary pressures. So that's why the commodity, the ratio of the S&P versus the Bloomberg Commodity Index is not showing any negative or bearish divergence yet, which is translated to what I call, i.e., the circular bullish trend of 2009, means from March 2009 onwards, still remains pretty intact. Okay, we're talking about long-term trend now. We're not talking about daily trend or weekly trend. These are very short-term in nature. So I'm talking about the longer-term trend first. So I hope that you all can differentiate So if you are talking about intraday traders, you are trading on the intraday basis, definitely you will not be using this chart. And if you are talking about shorter term trading or weekly, you should actually look for my weekly technical outlook rather than looking at this chart. But this is more about quarterly outlook. Okay, good. Now, moving on to the next chart, liquidity. Okay, so now what is liquidity? Liquidity is also very important in the system. Why? Because it measures the gauge of, hey, will the liquidity be tight or loose in the system? Okay, so this liquidity, right, is, think about it, is as something like a amount of cash that is flushing in the system, is circulating in the system. The more cash circulating in the system, this cash got to go somewhere. Means the cash got to get a higher return, right? Which is investing in risk asset like stocks. Okay, which is one of them. Okay, so the current liquidity situation based on 7th of April data taken from this Merrill Lynch Global Financial Stress Index, if it start to spike up, that means we're talking about liquidity is very tight. So this last spike up, right, was seen during the pandemic crisis. So somewhere around in February to March period, it just spike up because the liquidity is tight. So that actually causes the market to correct. All right. So this one can be used for multi-month purpose, quarterly purpose. So right now, if you look at it, how you know that over here, anything that's below zero, the liquidity is abundant. That means there's lots of liquidity in the system. So the key thing over here is liquidity, right? There must be two extreme as well, like overbought, oversold. So we know that if the liquidity is too tight, right, central banker will start to come in and pump liquidity. So this will happen when the Z score goes above 2. Okay, so now my concern is that we know that liquidity right now is at negative 0.2, which is there's abundant liquidity, but has liquidity come down to a level that is very, very oversold, the Z score on the lower boundary, that is too loose that it will start to have a bit of inflationary pressure where central bankers worldwide will start to give a bit of hawkish guidance. Hawkish guidance are not talking about tightening. So sometimes central bankers will give a bit of guidance telling that, hey, maybe the economy right now is a bit too hot. It's time to actually cool down a bit. So the key thing is that one thing I like to look at is this Z score here. Yeah, liquidity here is abundant, but it hasn't reached extreme oversold level here of close to 2, negative 2. So what it means that over here, liquidity still remains abundant, but not at the extreme level yet, as indicated by the Z score. Okay, this level over here. Okay, so overall liquidity is loose and it hasn't hit the extreme level here yet. That may cause a risk of a liquidity tighten scenario from a multi-month perspective. So overall, it still be positive or favorable for risk asset. Okay, now moving on to the next chart here. Okay, this will be the performance. Okay, so what I'm doing over here is that it's the ratio chart as well, taken from the 5-year performance since April 2016 all the way to 12th of April 2021. Okay, just 2 days ago. Okay, this is the US Treasury yield. So you look at the US Treasury yield has started to increase significantly since the start of this year. Okay, start of this year. In fact, prior to somewhere around in September, it started to increase gently. It's only the start of this year, the rate of increase, right, start to steepen on the US 10-year Treasury yield. So now it's about 1.7%. Okay, so what's interesting is I want to take a look. I'll explain slowly step by step. What is this chart? It's basically a ratio chart. It's a chart of, let's say the first one, the green one, is I measure the stock price of FANG. That means FANG. What's FANG? Is Facebook, Apple, Amazon, Netflix, Google, plus Microsoft, divide by the S&P 500. So if this line is going up, because of the ratio is going up, that means this FANG plus MSFT, Microsoft, is outperforming the S&P. Everybody clear? So I want to take note is this, during somewhere around here in September last year onwards until now, you look at the outperformance has started to slow down. Notice that previously they were outperforming very steadily. Now the outperformance has started to slow down because the ratio is actually turning downwards. They actually indirectly correlated to the rising treasury yield. So that means what we can say that if this treasury yield keep on going up, your performance of your FANG plus MSFT will tend to actually be lesser compared to the S&P. Clear? Now let's take a look at information technology. That means a bigger one, which includes all the information technology players, like semiconductor is one of them. The sector divided by the S&P. Okay, it fared slightly better than the FANGs plus MSFT, but it started to go sideways. Previously, it was actually outperforming in line with the treasury yield that's coming down, but now treasury yield is going up. it starts to go sideways. That means i.e. outperformance being muted as well against the S&P. Communication service, nothing much, also sideways. Consumer staples, utilities, real estate over here, pretty muted as well. And what's interesting is this bunch over here. You look at the consumer discretionary, which is cyclical in nature as well, has starts to improve. Notice that recently, due to also in line with a rise in the US Treasury yield. Financials versus the S&P has improved as well. Industrial materials over here has also improved. And the last one I'll share with you will be the energy. If you look at the energy stock, previously the energy sector has been underperforming the worst against the S&P. Now it starts to show signs of improvement. Higher high, higher low. So recently it hasn't cut below the last low, even though last couple of weeks, around about 3-4 weeks ago, it started to do a bit of profit taking, which is reasonable given its steep rise in the first 3 months of this year. So, but it's still trading a series of higher low. That means what? It means that, hey, this bunch of cyclical year has started to outperform the market, very interestingly, due to the rising US Treasury yield. So as we know that over here is that, hey, if inflation pressure starts to increase this quarter, that means, i.e., your US Treasury yield will slowly get bid up. As long as you don't go past 2.55%. Okay, we are still safe of a liquidity squeeze. I.e., that means cyclicals can continue to outperform. But definitely we talk about these stocks here, thanks and information technology, they are also pretty important. Why? Because the last few years of significant outperformance, they've sucked in a lot of capital inflows globally in terms of fund manager, in our pension fund, and even retail investors as well. So this stock, these two bunch here, they definitely cannot collapse. Collapse as in a big crash in information technology stock and FANGs and MSFT. That means, i.e., they will tend to hover sideways, where else the cyclical starts to move up higher potentially. Okay, so that's a potential team play that we may start to see, which i.e. will actually supports global equity circular bullish trend. All right, good. Now, following on, another team play that's taking place is if I talk about value versus growth. So there is this particular we call it ETF, where I plot the Russell 3000 growth against the Russell 3000 value. So these are a very 3000 we call it growth stocks versus 3000 value stocks. So you look at since 2006, right, growth has been outperforming versus value. And from August 2020 onwards, also in line with the rising treasury yield curve since September, that's going up, it has causes the growth to actually underperform the value because it came down. You see, negative 14% this end of March. That means this period of March, from August all the way to March this year, all right, okay, this should be a typo, is March 2021. Pardon me, it's not 28, it's March 2021. That means over here, what it means that over here is that the underperformance of growth versus value is the worst since July 2006. Okay, previous underperformance was only negative 7%, negative 8%, and this one was negative 14, almost doubled. So what it means that you may start to see a bit of significant rotation of portfolios adjustment from growth related stocks potentially more towards value, which is cyclicals. That means value can be energy, it could be industrial, it could be materials related. Stocks that are lagging, that are laggards when in the last 5 to 6 years. All right, growth stocks previously they are outperforming. That means we're talking about technology stocks. They may start to waver a bit due to the its negative correlation with the rising US Treasury yield, which is actually caused by rising inflation. All right. So now, all in all, right, these are the team play that could actually take place in this coming quarter. Okay, now look back again. Quarterly performance Q1 2021. Okay, over here at year to date. So for Q1, the one that is outperforming will be the one that most Russell 2000. then followed by Dow Jones. Why Dow Jones? Because it's related to the cyclical, heavily cyclical weighted, and Nasdaq actually underperformer because of it's heavily weighted towards the FANGs, Apple, Facebook, you know, Netflix, so and so. So what's interesting over here is that Hang Seng and Tech Index, in fact, since before the recent significant decline post the Chinese New Year break, they're actually up close to 30%. Because of that, it's actually engineered by the Chinese authorities to actually kind of slow down their growth. But what we see later, I'll share the chart of the Hang Seng Index. Not to be afraid. In fact, it's still being supported. All right, year to date is about 5%. All right, even the Hang Seng Tech, it seems to be have bottom up as well. So the next one will be Nikkei 225, then followed by the German DAX. So Nikkei 225 is kind of pretty performing significantly as well in terms of Q1 performance and year to date. German DAX definitely 9% up, 11% due to heavily weighted to cyclicals as well. Then our STI 10%, 12%. Why? Because our STI also heavily oriented to cyclical value thanks to our top three banks, DBS, UOB, and OCBC. All right. Then for those who wants to do a bit of normalization, so what you know that the K225, German DAX, and Straits Times, they're all in their own domestic currency. So what you could do is that we could use the ETF, that one that is their ETF, their parallel ETF that is listed on the US stock exchange, like this S&P Europe 350, MSCI Japan ETF. All these are dollar nominated to have a better comparison with the US index. All right. So all in all, what you could see is that 3%, 2%, 2%, then our Singapore outperform 8%. All right. So the rest, right, we're talking about once we normalize it accordingly to the US dominated ETF on the regional on the Europe side, MSCI Japan, Asia ex Japan, emerging market, they actually kind of also at the moment still underperform Q1 on Dow Jones and even the S&P. All right. So yes, Europe is catching up pretty significantly year to date, 8.37%. Then the one that is still outperforming so far, this is the MSCI Singapore, 8.3%, pretty much in line with the Dow Jones and the S&P. All right, and even the year to date performance is also pretty in line once you normalize it to US dollar. Okay, so far so good. All right, now. Okay, good. So now let's go to the individual technical chart. We start from Asia first. Okay, this is the recap of Q1 2021 outlook. So what we have previously is that I have a key long-term pivotal support. That means as long as 24850 on the Hong Kong 50 index, okay, which is Hang Seng, Hong Kong 50 we call it our platform, holds. We are expecting this Hang Seng to actually goes up towards 32,300. Okay, first target at 30,280, the resistance. So let's see for Q2. All right, so for Q2, right, the first resistance target was made 30,280. It printed a high of 31,114 in February before doing this deep down. All right, so what we do now is over here is that our actually overall is still trading in an uptrend. All right, since the low of March 2020, this trend is still up. So I will actually tighten the key long-term pivotal support. So as long as 25,760 holds, we are still expecting for this potential upward movement to actually hit this next resistance at 31,890/32,300. All right, RSI also coming very close to a support level right now. Okay, now Japan. So Japan at the point in time, we are looking at a key pivotal resistance or support level at 24,180/23,180. Potential resistance 29,400 to 35,520, 34,050 level. So over here, if you look at what happened, the first resistance or target has been made at 29,440, printed a high of 13,716. Okay, this level, then now you just go sideways. So those who actually follow my weekly technical outlook, in fact, from the February high until now, so it's close to about 2 months already, it's been evolving in a symmetrical triangle, looking for a potential breakout, which is due pretty soon. which potentially it may happen next week or a week or two, because more or less in terms of Elliott wave, the symmetrical triangle from the February high more or less has started to play out its wave count already. So, but for the quarterly outlook, 26,880 will be my long-term pivotal support. I will tighten it to 26,880. That means as long as this 26,880 holds, that means there is no weekly close below it. I'm still expecting the Nikkei 225 or the Japan 225 to actually shape another potential up move to test the next resistance at 33,520 / 34,050. All right. Now, this is the S&P. So S&P, right, previously everybody is afraid of this expanding wedge. So I say that that's actually been taken out very clearly. So 4,450 will be my target. 4630 will be these are the two significant resistance. Okay, so what we see right now is it continues to churn up higher. Printed the all-time high yesterday at 4148, which is yesterday. No signs of exhaustion yet. RSI, there's no bearish divergence. So I will actually tighten the long-term pivotal support for this quarter to 3510. That means as long as no weekly close below 3510, expect it to slowly churn up, potentially to test 4450, above 4450, 4630. So overall, the trend is still bullish for this quarter potentially on the SPX 500, as long as 3510 long-term pivotal support holds. That means no weekly close below it. Okay, and you look at this 3510 also in line with the 50-week moving average. All right, that has been supporting the previous up move, single up move of here. Then here it just go big sideways. All right, and since the March bottom low, then this is start to pull back, test, go up, pull back, retest, up, and right now it's at 3510. So that's why this moving average is also pretty key as well to watch. It's actually in line with 35 level, 3510 long-term pivotal support. Now, the next burning question will be your Nasdaq. Okay, so at the point in time, Nasdaq, I'm actually looking for further potential upside towards 16,630. So what we are seeing now, right, on the latest chart of Nasdaq, the weekly, so it started to shape this bearish divergence, which I'm pretty much concerned. So if you look at the RSI on the S&P, there's no bearish divergence, nothing. But if you look at the Nasdaq, very clearly there's a bearish divergence here, here, here. That means prices keep pushing higher, but your RSI is not doing higher high. It starts to show lower high, especially at the overbought level. So it means that momentum has started to slow down, okay, which is potentially caused by the rising 10-year Treasury yield. Okay, so what we have is that yesterday it printed all-time high at 14,002. So I have an upper limit level, which is at 14,040 level. So I'm watching this level very closely for this week. So as long as it didn't have a weekly close above 14,040, I will not validate a potential uprise towards the 16,630 level. I'll have this neutrality move. That means potential sideways below 14,040, maximum 12,000. But if 12,000 breaks, then maybe we're talking about a very significant corrective move, which is high unlikely to happen. Why? Because the rest of the global markets are still, the rest of the major global stock indices, are still shaping further potential up move, especially those that are cyclical oriented. So what it means that over here is that all markets must go hand in hand. Yeah, even though we're talking about potential underperformance of growth stock, which is Nasdaq 100, they cannot crash. Once they keep crashing down, that means they will have this kind of negative feedback loop that will actually cause a scare to the rest of the market as well. So that's how markets work. Think about it, it's like unwinding, a disorderly unwinding. So I'm more expecting of a neutral sideway between 14,040 to 12,000. So unless this week we have a weekly close above 14,040, then I could actually validate a potential bullish move for this quarter on the Nasdaq 100. Okay, so now moving on to the next one. This is Dow Jones, we call it US 30. So trading in a very we call it ascending channel, very clear ascending channel since March 2009. No bearish divergence, hasn't even hit the extreme overbought level yet. Okay, previous extreme overbought level was here. That actually coincide with the Jan 2018 high before this very nasty sideways move took place. Nasty as a nasty corrective move. Okay, so now there's no such momentum is still pretty strong, I would say, on as indicated by the weekly RSI. So what I'm expecting over here is that 29,400 key pivotal support for this quarter. no weekly close above, but no weekly close below 29,400. Potentially, I'm still expecting a further potential impulsive upmove sequence to actually hit this next resistance, which is the top of the channel, and some favourable expansion level, 37,050 slash 38,450. So yesterday it printed an all-time high at 33,826. That means we surpassed this first target of 33,680 already. All right. Now, another one that is I highlight for the start of quarter, right, is this very strong performance of small cap that surprised me in the month of September to October. So I expect that this move to actually to continue in Q1 this year to a target of 2310 slash 2365. Where this push out, there's a bullish. This is the we so-called the bullish exit from here. So if I look at it over here, it has really hit 2367. Okay, I have 2365. It printed 2367 on 15th of March, and you realize that since now it start to go sideways. And what it's showing is that it's also show the same characteristic in our RSI, the bearish divergence. All right, so that's why because of this bearish divergence here, I'm so very reluctant to actually validate a further push up from 2367. So I would say it's more like a sideways move for this quarter between 2367 and 20,060. It's part 2065. So more like a sideways movement, unless it has a weekly close above 2367, then I will actually be more confident to actually say that, hey, we may start to see further potential upside towards 2460, then a break above for about 2640 slash 2755. So similar like the Nasdaq 100, more of a sideways move this quarter, potentially for the small caps, which is the Russell 2000. Okay, so I've covered the indices, the European one. One more will be the German 30. So the German 30, okay, pardon me, I've covered the US one. It's German 30. So German 30 as will be a proxy of Europe. I would say Europe. So previously, right, we have a potential movement to 50,020, 16,685 with the pivotal support at 11,330. So that was my Q1 outlook. So now for Q2, okay, it already hit the 50,020 level. That's my first resistance. It already met. Printed all-time high on 6th of April at 15,329. Okay, so what we are seeing right now over here is I will tighten the key pivotal support to 13,180. Previously, as is at 11,330, I push it up. Okay, simply because the price will start to move up. So as long as this level holds 13,180, no weekly close below it, I'm still expecting potentially to actually see further potential up move within this ascending channel that is in place since March 2002. No bearish divergence on the RSI. Even RSI hasn't hit the extreme overbought level yet. So still looking towards 16,685. A break above should take us to 17,080 slash 18,120 on this German 30 index. So still pretty much positive. All right, on the German 30. Okay, now the next one will be FX. Okay, now I'll touch on FX. So before I touch on FX, so far so good. Everybody can see the screen and my audio is loud and clear. Okay, good to go. Okay, great. So I assume that the thing is loud and clear. Okay, Ken. So FX. So before we touch on the individual FX pair, the highlight is I'll tend to start this performance chart first. Okay, as of based on 6th of April, which I did. So year to date, that means start of this year until 6th of April. Okay, so what it means that i.e. that means if all these lines are going up, it means that the dollar is weakening. Okay, that means what I did is that I plotted Canada slash USD. That means one Canada equals to how many USD? One sterling equals to how many USD? This is standard, right? One Chinese yuan equals to how many USD? Then Aussie and Kiwi, these are same. All right, then Euro and Swiss franc. So what it means that previously, right, at the start of this year, until somewhere around late February, okay, we start to see the dollar coming back. That means the dollar outperforming. Okay, that means we're talking about previously, right? This thing going up, that means dollar is weakening. The rest, the currency is actually outperforming the dollar. So right now, it start to come down. That means it's telling that the dollar is actually strengthening against this currency. So the one that is the strongest, right, is still the sterling and the Canada, which are actually appreciate by 1.53%, 1.5% against the dollar. Okay, so far so clear. So the one that is weakening against the dollar significantly is your Swiss franc and your Japanese yen. Negative 5%, negative 6%. That means they are weakening against the dollar. Okay, so all in all, right, we start to see, hey, this dollar strength seems to be coming back into the market, but not at a very significant level yet. So how does it imply? If I look at the chart of, let's say we start to look at the euro dollar chart, okay, as a gauge, because it's that euro dollar in terms of psychologically, in terms of the dollar index has a higher weightage, and also in terms of the amount of volume traded globally is still the highest among the majors. All right. Okay, so if you look at this is the Q2 outlook for this quarter. Okay, yes, even though we start to see the last few months, last 2 months of euro dollar coming down, euro underperformance, but where it actually stopped, it actually stopped at this 116.50 level, which is the pullback line of this former descending resistance, now turns into a pullback support. All right, and potentially what is tracing out a potential double bottom. But this is a monthly chart, so it takes perhaps maybe more than 3 months to form to complete this double bottom. So what we have for this quarter, right, is I'm still using this 116.50 slash 1550 here, slightly below the 118.50 level as my long-term pivotal support. So as long as this level is not being surpassed to the downside, or no weekly close below 114.50, we could actually see a push up to actually kind of erase the last few weeks of decline, at least for this quarter, to actually go back to test the neckline resistance of the double bottom at 1.2555. All right. So this is kind of a now we are talking about a support, then push back up to potentially to the range top again. Okay, so talking about this coming quarter, a bit of dollar weakness, but not as significant as the one that we see from March last year, where we start to see a pretty strong dollar weakness. So this is more like a more minute dollar weakness to see a push up towards the range top for the euro dollar, taking euro dollar as the benchmark. All right. Now, moving over, the next pair I want to highlight for you is the Aussie, which is a very popular traded pair as well. And the Aussie over here also move in line with risk appetite. So if risk appetite is good, that means we talk about bullish equity, Aussie dollars tend to be actually supported as well, and even potentially bidden up to the upside. Okay, but what's interesting is that if you look at the last 2 months of price movement, it starts to form a shooting star in February. In February, then it starts to shape a decline. Not too drastic yet, but a shooting star. But where this shooting star stopped, it stopped at significant resistance right below 80.75, which is this former swing high here, former swing low, tested, never break above, come down, retest again, and also this former descending, we call it former support, broken, turns into a pullback resistance. And so coming very close to this descending trend line, the top all-timer of 2011. So there is this 80.75 here is pretty much stubborn, or what you call a very significant ceiling that prevented the previous thrust up, and it started to form a shooting star. But however, on the bottom right, it tends to be supported by, also it cannot go down too fast. Why? Because of the current risk appetite for stock is still positive. Okay, and also euro dollar being the proxy of the major pair, the rest of the world, is also being supported as well at this moment in time. Okay, so to me, I cannot validate a bearish move, neither can I validate a further push up towards 80.75 because of the amount of elements that are forming at 80.75, negative elements. So what I do for this quarter is I will turn neutral between 18.75 and the 70 level mark, the 70 cent mark. That means, i.e., it shouldn't go below 70, and it will toggle between sideways. Unless I have a weekly close above 80.75, that I could validate a further potential up move towards 89, then followed by 93.50. So because of that monthly negative element that is formed in the period of February, and there's a couple of resistance at 80.75 based on the various factor that we could found. 1, 2, 3 that highlighted. So I'll be pretty much neutral for the Aussie dollar. Okay, 80.75 and the 70 cents mark. Now, moving on to the next pair that I'll highlight is this pair is very important. Why? Because this one is moving according to the commodity price. So we know that commodity prices tends to be on the upside potentially due to higher inflationary pressure potentially as well. So the one that is moving pretty much close with crude oil will be Canada dollar. So what I did is that I did the inverse. That means one Canada versus USD. Okay, that is highlighted in blue. So once I plot this in inverse, right, that means if this blue line is going up, that means the Canada dollar is appreciating against the USD. Then I plot according to like crude oil futures, WTO or LCO, we call it inside the futures exchange. You notice that their movement, they are moved hand in hand. Canada versus USD, that means one Canada dollar, means Canada dollar is appreciating against USD. It moves in line with higher oil prices. If the oil prices starts to fall, the Canada dollar will depreciate against the USD. And most importantly, if you look at since March low, the rise in the crude oil price has been moving hand in hand with the rise in the Canada dollar versus the USD. That means Canada dollar appreciating against the USD. And the correlation over here that I plotted is 0.8 on the average, which is pretty high. All right, we can look up since 10 years ago or 12, yeah, in fact, more than 10 years is about 0.8 on the average at 0.8. So what it means that the movement of crude oil prices will be very, very sensitive towards the movement of Canada dollar against Canada versus the dollar, which is dollar CAD. Those who trade the US candy. All right. So with that, right, that means if crude oil prices going to go up, that means i.e. the Canada dollar should actually appreciate further against the USD. Okay, so now what we do is that we plot the normal one, that means taking US dollar, 1 USD against Canada dollar, because when it comes to trading in the markets, very seldom people will quote Canada/USD. Why I quote Canada USD? Because I want to share with you all the positive correlationship with the Canada dollar versus the oil price. Okay, so now come to normal convention, right? We use dollar CAD. So this dollar CAD, right? This is the money chart. So what's interesting in this money chart is this impending bearish double top that is forming since Jan 2016, March 2020, 4670/90. And when this double top form, take a look at the very clear bearish divergence on the monthly RSI. And it actually broke below the 50 level, which is the former ascending support level as well. Okay, haven't reached the extreme oversold yet. That means on the longer term basis, momentum is still pretty much intact on the downside. So right now, technically, right, there's this neckline support here. I got to watch 2070. So if this level breaks, it could actually go down to this zone here, 112.20, 1.0660, which is correspond to this ascending support, very long-term ascending support, November 2007. All right, and this significant congestion zone over here as well previously. So now what's on this is the monthly chart. So we know that monthly chart is bearish. So how about the quarterly outlook that I use the weekly chart to actually determine? So what we see right now is that the weekly RSI now is coming very close to the oversold level, pretty close with the. So what it means that it could do a bit of push down to actually test the 120.70 neckline support of this impending double top. Then thereafter, maybe a bit of sideways movement to work out this oversold level on the weekly chart. Okay, may bounce towards 3020/3320. So as long as 37 figure never break, which is this former ascending support turns into a descending resistance, former ascending support turns to a pullback resistance. And if we do the Fibonacci retracement from the March 2020 high all the way down to the current low, is about 61.8% retracement. We're so coming at 37 level. So as long as this 37 level holds, means there's no weekly close above it. After this potential sideways movement, okay, it can still drop potentially to actually test the first support level, for this coming quarter at 1220. Okay, so overall, right, this is one of the pair that I like to be more closely watch. Aussie dollar, we got to see whether can it break above the top side at the 80.75 mark, but the dollar CAD seems to be exhibiting more bearish elements. Okay, then the euro dollar will be a push up towards the top of the double bottom neckline resistance. So all in all, what you could see is that the recent dollar strength that we start to see post Chinese New Year seems to be getting a bit weak, abated already. So what we could see a bit of dollar weakness coming back into the picture, but this dollar weakness in terms of magnitude should be lesser potentially compared to the Q1 dollar weakness that we saw previously, and in Q4 as well. So that will be lesser in terms of magnitude. Okay, still dollar weakness, but their magnitude lesser in Q4 and Q1 this year. Clear? All right. So now moving on next to my last one, the broader base index will be the commodity price. So in fact, this chart I already flashed earlier on already. So we could see that WTI crude year to date is the one that is increased the most significantly, about 23.4%, followed by 24% for Brent crude and WTI. So the one right that is still kind of lackluster is the gold. Later I'll touch on gold and silver. Okay, gold, silver, and you have coffee. This will be the soft commodity. So the rest are actually increasing pretty significantly, both in terms of year to date and in terms of the 3 months as well. Okay, the last 3 months. So now let's start off with the Bloomberg Commodity Index first. So this is the broad-based index that covers everything. So what we see over here is that this commodity index, this monthly one, the RSI momentum is pretty strong. Why? Bullish divergence, breakout of this resistance on the RSI. So RSI is a quick adjustment. Definitely, RSI is a measurement of momentum, momentum indicator. So what you see is that RSI has an overbought oversold zone. So if we hit at the overbought zone, there is a potential of a pullback or a reversal on the price action. Reversal is when start to see bearish divergence. So based on 7th April data, there's no bearish divergence and it hasn't even hit the overbought level. So what it means that long-term momentum is still pretty positive on the Bloomberg Commodity Index. This that covers everything, including oil. Oil has the highest weightage, definitely. There you have precious metal and livestock as well as soft. Okay, so overall as a whole, right, it means that commodity prices still has room to go up higher to test 104.50. So above 104.50 should take us up towards 121, then followed by 159/170, which is the 61.8% favourable retracement from the all-time high of July 2008 to April 2020 low. Okay, so and also there's this congestion zone here as well, which confers with 159/170. So all in all, right, commodity prices as a whole is still potentially bullish for this coming quarter Q2. Okay, now what's go on in copper? Let me start with copper first. So for copper, right, this Q2 outlook, since hitting the high of 417.90 copper, it start to go sideways, and in fact it start to form a potential triangle formation. So what I do over here is that, okay, this is the double bottom breakout. So the exit potential for this double bottom breakout hasn't reached yet. It's at 45250/46430. So I will use the neckline resistance, now turns to pullback support, as my key support for this quarter, 327.40. 327.40. As long as the weekly close below 327.40, potentially after this completion of this symmetrical triangle, or somewhere quite pennant, it will eventually still goes towards this 45250/46430. A break above 46430 should take us up potentially higher to the one-time FIBO expansion from the low of Jan 2016 to Jan 2018. This push up then projected from the low of March 2020, the one-time FIBO expansion, it actually stands at 519.20. Okay, so still pretty bullish for copper for this quarter. Yeah, now light crude. So light crude oil, right, so far from this historical negative 40 level, it has been see a very strong recovery from the April low last year, and recently, right, it actually stopped at 66.666 again. This number appears again. So this level, why is it so important, is coincident with the previous swing high of 2019 to 2020 that led to this plunge, and also this long-term descending resistance that is capping all previous recovery since July 2008, right exactly at 66.60. So I will actually use 66.60 as my upside trigger level. If we could see a weekly close, okay, RSI here over here is not hitting the overbought level yet. It's still pretty neutral, I would say, still inching up potentially higher. So but it got to break above 66.60. So a weekly close above 66.60 on the WTI crude oil futures, with 50.60 as the long-term key pivotal support. That means as long as there's no weekly close below 50.60, a break above 66.60, that means weekly close above 66.60, we could see up higher towards 75.70/87. Okay, so that's my outlook potentially for light crude oil futures, WTI, for this coming quarter. So overall, it's still bullish, but it got to break a significant resistance at 66.60 to actually reinforce this potential push up to test this next longer term resistance at 75.70/87. Okay, now the next one question is gold. Okay, so before I talk about gold, right, why gold has been pretty minute or pretty muted against the rest of the commodity, because the rest of commodities are outperforming, gold is kind of muted. Okay, one of the reasons is that if you look at the narrative, is that hey, because gold itself is a zero interest bearing asset. That means, i.e., if I buy gold or if I hold gold, I will not get any interest income. That means I will not get interest income if or yield or even dividend, and there's nothing if I buy pure gold. So what I could get gold is only capital appreciation. Okay, so the key thing is that gold is actually competing with other financial asset that give you a steady stream as in what? As in more or less a kind of a fixed income stream, like fixed deposit. All right. So the thing about fixed deposit, everything goes up with cost of funding. So earlier on, I talked about the cost of funding is the 10-year treasury yield. Okay, so if the 10-year treasury yield keep going up higher and higher, that means potentially your cost of funding will go up, which translate to certain fixed income instrument, like your fixed deposit will also go up as well. Okay, so that actually defeat the purpose of holding gold. All right. So, but then now I try to plot the correlation between US 10-year real yield. That means I get the yield minus off inflation expectation. So I plot this long-term correlation since 1965. That means I take a very long time data frame. So I found that the correlation coefficient between the US 10-year real yield and gold price is not very strong. That means, i.e., right, if we have the narrative saying that US 10-year real yield goes up, gold price will come down. That means they should have a very strong positive correlation coefficient around 0.6 to 0.8. However, when I plotted it the long-term data, taking from the data from 1965 onwards, it actually has a negative correlation of negative 0.38, not negative 0.6 or negative 0.7. That means it's a kind of reading that's saying that, hey, in the very longer term perspective, right, the US 10-year real yield is impact doesn't have a strong relation at all with gold prices movement from a longer term perspective. All right, so statistically, it's been telling us that, hey, that means this gold price, in fact, is not being primarily driven by an increase in US 10-year real yield. If I take a very long data to actually plot their correlation coefficient, okay, because it's not showing a very strong direct coefficient of positive 0.6 or even positive 0.7 or positive 0.8. It's just negative 0.38. Neither here nor there. It's not negatively correlated significantly as well. Okay, so with that in mind, right, I look at the technical picture. Okay, so what you see now, the recent prices of gold, very interestingly, what they do is they start to bounce off from this 100-week MA and as well as this descending support line that I draw, and the previous congestion level here and here at 1670/40. Okay, your RSI is also bouncing off from a significant support at the 34 level. Okay, so with that, right, you see the last week it start to form a bullish hammer on the weekly chart, and potentially what we could see now is a bit of sideways movement above this 1640 level. So as long as this 1640 level holds, that means there's no weekly close below 1640 level, it could actually slowly inch up potentially higher to retest this 1965. Okay, why this 1965 is important? Because previously the last push up in Q4 last year actually stopped at 1965 level, which was the previous significant swing high, and thereafter it shaped this significant push down. All right, to a low about 1670 level. Yeah, 1670 was the low. Okay, so unless we have a weekly close above this level 1965, then we could see it take up the August all-time high level at 2075. But all in all, with that, right, it still has a kind of bullish bias to actually push up to the recent high at August 2020. Okay, so I technically speaking is actually at a support, significant support. Elements start to turn positive, the bullish hammer from here at the 100-week MA at this congestion level graphically, RSI at support level as well. implying to us that we may start to see a potential push up in gold. Okay, but not to break new high yet for this coming quarter. Then now how about the last one, silver? So you look at silver, right, is doing this rounding basing configuration since December 2015. Then from the March low, you just do a very simple push up. Then ever since for August until now, you just go sideways. So what you see for silver right now over here, this cash, right, is trading in a kind of a impending symmetrical triangle configuration. So what I'm expecting over here is that it will be still sideways. That means a push up to 29.87, 29.86. If this level can't have a weekly close above it, it will just go sideways for the rest of this quarter for silver. Okay, so pretty much sideways for silver between this 2020, which I take into account this the line of this double rounding basing necklines resistance previously turns into a pullback support, very close to the triangle low, which is at 21.65. Okay, so it's give or take, I'll just put 2020. So still pretty much sideways between 2020 and 98 and 29.86. Okay, so this is the sideways configuration for silver. All right, so now I already covered the entire global macro picture from equity all the way down to FX and stocks. So we'll give about quick FX and commodity, pardon me. So a quick recap over here is that we still see higher potential prices in terms of global equity. All right, no big crash coming into the picture yet for this coming quarter, but potentially we could see still continuation of underperformance of tech and growth stocks versus the rest of the team like cyclical and value taking shape. Unless that's why Nasdaq 100, I have a prefer a neutral stance unless we can have a weekly close above the key resistance level that I highlighted earlier on, that I could validate more confidently the potential push up on Nasdaq 100. Then US dollar over here is that I'm still expecting the US dollar to remain weak for this quarter, but the momentum should be the weakness of the US dollar momentum should be lesser compared to the one that we see in Q4 last year and Q1 this year. Then commodity prices remains firm for this quarter. Then for gold, I feel that it really come into a major support level at 1640. So expecting a potential push up from here, but I do not expect to break new all-time high for gold for this quarter. And for silver, it will just consolidate between that symmetrical triangle configuration that I shared with you earlier on. All right, so with that, right, we now come to we have some time left, about 5 minutes for Q&A. So feel free to ask me any question that I'll try my best to answer. Yeah, anyone have any questions? You can just type it on the chat box. Yes, anyone have any questions? Because we have still about 5 minutes more, so I could answer any of your question. Okay. Okay, so treasury yield goes to what level that will cause the market crash? Okay, so the treasury yield, right, will be 2.55%. Okay, so let me go back to the previous chart that I have over here. Yeah, this is the key resistance level, 2.55%. Okay, so 2.55% is my level to watch. So if this level breaks, right, it implies a breakout of this long-term descending channel since October 1987, and also this previous important supply and demand zone that is taking shape since 2011 all the way to 2018. Okay, this big sideways congestion here, which is close to 2.55% as well. So 2.55% is a key level to watch. Then the next question is, any sector rotation this quarter? Yes. So for sector rotation, right, we are talking about the sector chart. So I'm still expecting the US Treasury to actually slowly inch upward to actually test around between around 2% level, somewhere around there. So what we could see is that in terms of sector rotation wise, I'm still expecting further outperformance of the consumer discretionary, financial, industrial, materials, and energy. These are the few things. So for information technology, we've got to be very careful. And thanks. Okay, some of them will outperform. We talk about some individual stocks, but as a sector as a whole, it tends to be more sideways versus the broader market. For that's the sector rotation, a strategy potentially that we could have in Q2 this year. So the next question is: buying bonds funds similar to buying bonds? This one, okay, it depends on what kind of bond we are looking at, because you know that buying bonds, we have corporate bonds, we have government bonds. It all depending on the bond funds, what are they in. So if you are looking for bonds that are government related, that means the funds definitely government related bonds. So yes, it's pretty similar, but we got to ask ourselves what kind of bonds we are buying. They're pretty similar, but I expect that depending on some of them, it may have a bit of tracking error, because some of the fund manager, they're trying to replicate the mother instrument using various instruments. Because this one, you got to look at the prospectus and the description of the bond funds more clearly. Okay, any comment on both Shanghai and Shenzhen index? Okay, so to me, right, I look at CSI 300. Okay, so to me, I feel that the CSI 300, okay, which comprises of stocks that are listed in Shenzhen and Shanghai. Okay, because one way I look at it over here is that I believe that it really comes to a key support for CSI 300. So definitely the I do not see a further potential fall from here. It's more like a sideways for the China stock market, with the stock market. So, but I'm very interesting to watch how the China big tech perform. Why? Because I feel that number one, previously the worst performer Alibaba has already shaped a bullish reversal. So those who followed my Twitter, actually I tweeted on Sunday, right after the announcement, the what I call the fine, saying that the Alibaba share technically has started to show positive element, and indeed on Monday it start to gap up and it start to actually outperform since starting Monday until now versus the rest of the big tech. So I believe that the regulatory overhang in the China tech space has more or less been settled down. So potentially we could see a bit of push up, but still kind of a sideways configuration for the China big tech stock, which could actually translate to a more supportive environment in the China related stock market. I hope that could answer your question. Okay, what does it mean for bond fund prices if the treasury yield go up? Okay, so in a nutshell, if the treasury yield keeps going up, bond fund prices will keep coming down. And it also depending on what kind of bond fund you are looking at as well. Certain bond funds that are more sensitive to the yield. Okay, that means i.e., that means not one for one. A 1% increase in treasury yield, 10-year yield, doesn't translate to a 1% decrease in bond fund. Some bond fund may decrease, pardon me, a 1% increase in 10-year yield will not have a 1% decrease in bond fund prices. It depending on what bond is it. So a bond fund that consists of high yielding corporate bonds, that means you talk about corporate bonds, junk bonds, we have lower credit standing. So definitely if the risk-free rate goes up by 1%, the 10-year goes up, that particular bond fund that consists of junk bonds will actually drop much more faster. That means for example, 3% versus a bond fund that has higher credit rating corporate bonds. All right, I hope that answered your situation. Okay, last question before I go 8:30 already. Okay, with the current COVID situation, is SLV or healthcare sector a good investment? Okay, so we're talking about SLV. Okay, so SLV is the healthcare, so it comes into line with pharma. Okay, so if I look at this over here, it seems to be a bit neutral right now for healthcare sector. If I look at the technical configuration, so to me is that I could actually plot the XLV chart in my Twitter feed. So I'll plot it on Friday. So keep a look on that, on the technical elements on this SLV. Okay, but to me, last few days I have a quick glance of SLV. It's more pretty much of a neutral. So in terms of outperformance, technically is still in line with it's still favoring the cyclical and value play. All right. So with that, I really I hope that I could answer your questions. So definitely the recording about with this recording on this webinar will be posted on my Twitter feed as well. And you actually link to our CMC YouTube channel. All right. So for those who wants to follow my Twitter feed, so how to follow me over here is that basically, okay, let me for the start of this chart here. Oops, here. Okay, so actually you sign up a Twitter account. Then from there, right, you actually tap in at Kelvin SC Wong, or in small cap will do. Then you're able to see my face. Then just click follow. Then you're able to follow my Twitter handle, where I tweet regularly, almost every day, about the market updates. And occasionally, I'll actually post some interesting chart there as well. All right. So thank you guys. And ladies and gentlemen, I hope that you have a great evening ahead, a great week ahead, and a great quarter ahead. And we shall speak again soon. Thank you. Goodbye.